soul destroying in many ways at the time. And it did, I think it's fair to say, it did suck energy away from the opportunity that presented itself. We were quite focused on patching up the problem assets, not focusing on, and that's a lesson I think that's come out of that downturn for today, is whilst, of course, and we're very focused on looking after the stresses that occur in our portfolio, but we can't make it at the expense of new opportunities which are going to present themselves. What do they say? The most dangerous words in investment are, it's different this time. So I think you're right. I think, yes, it's easy to forget, and it's easy to be caught up in the moment. And I think most of us are in this business because we're optimists, and you always hope things will be different.
Yeah.
But it was Mark Twain said, wasn't it? I think that history doesn't repeat itself, but it does rhyme.
Welcome to the People Property Place podcast. Today we are joined by Rob West, managing partner and co-founder of Clearbell Capital. Rob's specific responsibilities are for developing new business and deal origination, and he's also a member of the Investment Committee and head of the ESG Committee. Over his 30 years in the real estate industry, he's been involved in the leasing, investment and asset management of approximately £2.5 billion worth of UK property. Rob, welcome to the podcast.
Thanks, Matt. Nice to be here.
Not at all. Well, look, I'm really excited about unpicking your career a little bit and understanding a little bit more about the businesses that you've set up and views on the market. But a place that I always like to start this conversation is how and why did you get into real estate?
Well, as an anthropology graduate, it wasn't an obvious connection, it's fair to say. But I had thought about real estate before going to university. But I didn't want to go and necessarily read land economy. I tried to get into Cambridge and they decided they didn't want me. And I'd grown up very near Reading and Oxford. I didn't really want to go to Oxford Brookes, Oxford Poly as it was, or Reading. I wanted to go a bit further afield and do something else. And I was also keen rower and rugby player, and Durham appealed to me quite a lot. In fact, at one point I wasn't going to university at all, and I was on holiday in Cornwall with a cousin of mine when I got my A-level results. Yeah. And he said, if you want to have a really good time, go to Hatfield College, Durham, and read anthropology. And that's what I did, and he was quite right. And in fact, ironically, he is now chief exec of the RSCS, called Justin Young. Yeah,
well, so he's got a tough job, man.
He certainly has got his work cut out there, yeah, as he admits.
So you went to Durham, did anthropology.
Yes.
What did you think you would do after you did anthropology?
To be honest, at that age, I wasn't really thinking very far ahead. I didn't really have much of an idea, but I had this inkling that I wanted to go into real estate. So I remember my father sitting me down in my last year at Durham and saying, now, what are you going to do? It's high time you sort of grew up a bit and acted responsibly. So I said, well, I'm interested in property as a career.
Yeah.
So he said, well, my father actually was a lawyer, did a lot of property work, and he had a few connections in the property industry. And even though this was now 1990 and we were going into, at that point, the early parts of a major crash, a major recession and real estate downturn, through his connections, I was able to get a job. So I got an interview with a firm that just happened to be looking for a graduate at that time.
Amazing. So
I was very lucky, and I ended up at a firm called Daniel Watney in September 1990, which I think if you look at the charts was when the city market went into freefall, and that was the market I was in.
So where did real estate factor in? Where did that kind of enter your psyche, and what prompted you thinking kind of real estate is a kind of a viable career option or something you wanted to explore?
I think there is a connection between geography, and that was always my strongest subject at school, and real estate. Now, I went on to City University to do the real estate, well, I actually went to diploma in property valuation and law at the time, which is now a master's at Bayes. And actually, most of my peers, a lot of my peers, had come from a geography background. So I think there is a connection between the sort of human geography side of things and being interested in how towns work and how demographics interact into real assets. And I also liked, there was some sort of part of me that liked the sort of the income producing side of things. You could own a building, you could collect rent, and you could make money. It was a sort of monopoly side of things that appealed, as well as the academic side coming from a geography background.
It's blending it all together.
Yeah.
Sort of real estate is an interesting section. So I guess through your father, you've probably been exposed to a few different industries.
Yeah,
right?
he was involved in some quite interesting deals, like the Royal Exchange. He acted with a lot of city livery companies and that sort of thing. So I picked up a bit of that. And my mother's family have a bit of a property interest as well, which is still going, although it's pretty diluted today.
Yeah.
But I've been involved in that, and that again gave me an interest in a couple of small buildings in the West End that I was able to see how they worked and how the tenants worked and how the value went up. And there's money to be made, and that is appealing when you think about what to do.
Yeah.
There was an attractive side of it that you didn't have to be a city trader. A lot of my friends went to the city, so a lot of my contemporaries from Durham qualified as accountants, and that didn't really appeal to me. Or they went to the city, and at the time, getting up at 5 a.m. didn't really appeal to me. So I thought actually real estate is something that is a better work-life balance, and is something that interests me. So give it a go. And I also like the fact that not many of my friends were doing it either at that time.
Interesting. So you landed at Daniel Watney, and the market was going peaked on. As a graduate, or?
Well, sort of graduate. I mean, at the time, they didn't really know what to do with a non-cognate graduate. So I sort of came in on a trial basis. And after about 6 months, it was clear that this was something I wanted to carry on doing.
Yeah.
So I then applied to City University, which at the time ran an evening class for people who needed to convert from non-cognate backgrounds into a real estate background. So I joined a funny little course there, which was 2 nights a week for 2 years. So it was pretty high level, really. But it was some interesting people on that course who I've stayed good friends with, who've all done well. Going forward, people like Toby Courtauld, David Marks was on the course at Brockton, Joe Frood and Jack Pittman from Paloma.
Oh, really?
Nick Preston at Tritax. So there was a good cohort. It was relatively small, but we got what we needed, which was a diploma in property valuation and law, which got us to our ICS qualification. It was good. It was hard work there because I was doing city agency by then, and you're running around all day doing viewings, and you go and sit in a hot lecture theatre and listen to a 3-hour law lecture, and it's a question of how long it takes you to fall asleep.
Yeah, I can imagine.
But as I said, it was a well-run course, and
had some mates there.
We made some good connections, and we got what we needed, which was to get the qualification.
So you did 5 years or so, or 6 years at Daniel Watney. What prompted you to leave, and why did you leave? Because you landed at Nelson Bakewell.
I'd been trying to leave for some time because I was doing, by then I started off doing rent reviews, which was a great background. And then I moved into city agency, which was a really good thing to do at the time because there was a huge amount of development coming out of the late 80s that was sitting around empty. And every day there was another launch party or a relaunch party. So it was a very social background, got to know a lot of people, got to learn about the business. But by then I'd worked out that I wanted to move into the investment side of things. And we didn't really have an investment department. I tried a few things. And actually I answered an advert from the Estates Gazette for an investment surveyor at Nelson Bakewell. And I was lucky that I worked with a chap called Simon Marriott previously, who by then moved on to Henderson. And he was ex-Nelson Bakewell and was good friends with Rob Knoll. And it was Rob Knoll that was recruiting for the role. So Simon put in a good word with me. And I managed to get the job with Rob to join the investment team at Nelson Bakewell, which was really thriving at the time. I mean, Rob was a really effective agent, and Charlie Allison ran the buy side, and we were doing a lot of business with GE Capital, and quite a lot of public to privates going on, and it was just a really exciting, dynamic business. When I started there were 120 people. Yeah. By the time I left 5 years later, there were 350.
Wow.
So it was a really fun, work hard, play hard environment. Yeah. And I really enjoyed investment agency.
Why investment agency?
I guess partly financial. Within the agency world, it's the highest earning part of the world, and also struck me as being the most challenging and the most interesting, and that would lead on in due course to move client side, which was always, from quite early in my career, something that I was keen to do at some point. But agency was great fun while it lasted.
And what was that? The client side piece, was that because you wanted ultimate decision making responsibility or ownership over what happened? And actually broking a few deals was great, but you couldn't see the business plan and the implementation, what happened post you selling the building to a fund. Was that kind of
that was a big motivation.
Why?
That was a big motivation. You write a business plan, and then you just hand it over to someone else. In fact, I have to say, now working through a downturn as we are now, the idea of walking away from the building once you've sold it is quite attractive.
Yeah, I can imagine.
But that was definitely a motivating factor. Yeah. And I think also it's the challenge. I think I felt that was, it's harder. There's no question. It's difficult to make the right choices. Yeah. And to challenge yourself to do that regularly is appealing.
So how did that client-side move come about then? Because you were at Nelson Bakewell for just shy of 5 years, and I think they were sold to Capita, weren't they?
So I left before they sold to Capita. I was approached by a couple of guys who were setting up a new agency business on the back of Smith Gore. So it was SG Commercial or Smith Gore Commercial, but it was a standalone niche investment business. But I was only about 30. But it gave me the confidence to go and set up on my own, knowing that we had that wrapper that actually, in hindsight, didn't actually lead to too much in terms of business generation. But Nelson Bakewell was quite an entrepreneurial culture because it had been set up by the principals.
Yeah.
And so there were a lot of people did leave to go and set up their own businesses. It was quite a sort of a thing that other contemporaries of mine had done. So that was appealing to set up on my own with two partners and a blank sheet of paper. As we said, we had a blank sheet of paper and a phone and a desk. When we first started, we shared a phone. We literally analog handed the handset between the two of us when it was just James Dunlop and myself. So it was an interesting time, and it was great to be, three young guys with a new business and building that up.
And how did you know those guys? You worked with them at Nelson Bakewell?
I'd done a deal with James at Nelson Bakewell. So he was selling a portfolio for the electricity supply nominees, ESN, and I bought it for some quite spivvy investors backed by Indian capital. And it had taken a long time, and it had been an interesting process. But we got there, and we got to know each other quite well through that, and that was how it came about, that connection.
Interesting, because he's at Tritax now.
He's Tritax now, but he wanted a partner to set up.
Fine.
Who was more agency focused, because Colin Godfrey he'd identified Colin as someone he really wanted to work with, and that's been borne out by what they've done at Tritax.
Yeah, who's also at Tritax.
But at the time, Colin wasn't an agency, he was a fund manager.
Fine.
So he wanted someone with more of an agency background to bring in. And in fact, Colin spent the whole of our first financial year working on a deal for Tritax that never happened. But clearly, it's gone on to produce tremendous returns for them.
Yeah, quite. So Smith Gore was a backing, or they're going to kind of insulate you or pass business your way?
That was the idea. So at the time, private investors were becoming more influential, high net worths and ultra high net worths in the real estate market. And we thought that Smith Gore would give us access to their client base. Yeah. As it turned out, you've got an old established land agent in Yorkshire. The last thing he wants to do is introduce three spiffs from London to his favourite client. So it didn't generate the returns that we thought it would, but other things happened and turned out to become a great success.
So what were those other things? When you kind of realised, and how long did you realise that, getting introduced to this landed gentry or other high net worth individuals who are trying to access the commercial space rather than the residential space wasn't necessarily going to supercharge your business plan? How did you pivot, and what did you pivot to, and what did that look like?
Well, we didn't. That was always a sort of something that we would do alongside working with our existing clients. So we'd all sat down with the people we worked with before we started and said, look, will you support us in this new venture? And they were all really positive about it. So we all came in with a client base to a certain extent. Yeah. And we worked with that client base. And that grew, and new clients came along the way. Yeah. And we did try quite hard with Smith Gore. We did a roadshow. We went to all the local regional offices and we sat down. We had some quite interesting experiences in freezing cold houses in July in Dumfries and things like that as we went around. But it was a useful experience to go around and present and do the roadshow, even though it didn't yield anything. I think it was a good experience.
And then how did that business kind of evolve, and what did it evolve into? And what did that look like?
So that at that time became a general agency business. Subsequent to my departure, it migrated into Tritax effectively. So that then became Tritax. So when I was there, it was pure agency. And while I was there, my biggest client in the latter years was a business called Mountgrange. And they set up with Mayor Bergman, as was, a joint venture called UK Capital Partners, which was a friends and family fund. We had investors like the McAlpine family, and other high net worths, the Wilson Connolly family. And we built up a portfolio as a sort of precursor to both those businesses going on to become fund management businesses. It was a sort of trial, if you like. And whilst I was at SG Commercial, I bought all the assets for them. And a chap called Rob Rackind at the time was at Mayor Bergman, and Rob left there to move on. And as he left, he said, why didn't I set up my own business to take over the asset management? So that's what I did. And it was move to get me client side. So that's what I felt that was an opportunity to become an asset manager, to participate in the performance of the assets, and to develop my career in that new direction.
New skills, got the transactional
Yes.
capability and understanding. This is your opportunity to be responsible for delivering the business plan that you were selling or setting, right?
Exactly. Yeah, and the market was booming at the time. It was 2005, 2006. So it was exciting times.
And was there a personal cost to that at the stage in terms of, walking away from well-established business and, a skill set and something you'd kind of mastered and you were quite good at, clearly?
No, because I didn't stop doing that. So I did carry on doing some agency work as well.
Fine.
Which helped to pay the bills. So that certainly made the transition relatively smooth process.
Yeah.
And I joined up with two guys I used to work with at Nelson Baker. I had an office in Brooks Mews. And we were co-working before people talked about co-working.
Yeah.
So it was relatively low cost, low barrier to entry, but a productive process.
And Mount Grange were your kind of principal client?
So they were my principal client. I did work for other clients as well, but Mount Grange was the key one.
How was it difficult to generate new business at that stage? Or is it all about, I guess it is all about relationships and network. How did you go about trying to build your book and build your business at that stage?
Well, it was actually a relatively easy time to generate new business because the market was booming. So people were keen to do deals. So, at the time I probably thought it was down to my persuasion and my skill, but I think a lot of it was to do with the market momentum.
Yeah.
So that was really helpful. But clearly it's a relationship thing too. And I had a good relationship with Mount Grange, which I built up.
Yeah.
And that stood me in good stead. And that also takes the pressure off because you've got some regular income coming in to pay the bills.
Yeah.
It helps, and I think it helps certainly in the agency world to be more relaxed. If you're desperate, then I think that is
You can
picked
smell
up. You can smell it exactly.
Yeah.
You know yourself. If you're desperate to sell something, it's off-putting for people.
Yeah.
So that was certainly helpful to have that, and it gives you something to talk about. It's very important, I think, as an agent as well, in anything we do, to have. What are you up to? Yeah, you've got a good story to tell.
Yeah.
It's that certainly helps your confidence and it helps the process.
How did the fund perform at that time? Because obviously you mentioned it's 2005. Market's booming, but we all know that it didn't go on booming for years and years and years. There's probably a couple more years in it before it.
So we exited the vast majority of assets pre-2007. Well, we actually by the summer of 2007. So the market was still pretty. Everyone could see. I remember Martin Myers saying it's like a restaurant. When a year ago it was fully booked and there was a waiting list. The same again. At that point it was fully booked, but there was no waiting list, and you could see very soon there would be some gaps in the tables and things. Prices would start to fall, but we got out just in time.
By luck or judgment.
More luck than judgment.
Really?
Yeah, I think it's fair to say. I think you could tell it couldn't carry on forever. And as I said, it was a relatively slow car crash in some ways because it started earlier in 2007, maybe even late 2006. So you could see it gathering, and then there was a credit crunch in the summer of 2007. But it's one thing seeing it in real estate, another thing being able to exit. Because if your assets aren't ready, if you've got land without planning consent, then it can be very illiquid, particularly when people sense that things are a bit toppy.
What are the kind of indicators you look for to kind of give you a bit of an early warning, or is it? Are there too many? Is it gut feel? Is it how do you kind of get a bit of a read on these things? You've been through a couple now.
Yes, I think there are two things. So I think there are two key drivers, obviously, to a downturn. One is investor confidence, and one is tenant confidence, and what is happening in those respective worlds. And you can sense certainly investor appetite. If you're putting something on the market and you get 10 bids, then the market's in rude health. If you get one bid, then there's clearly a lack of capital. Yeah. So in 2000, it just got too crazy. Everyone did the market, and then I think people started to work out, and then the cost of debt starts edging up, and then people start to get concerned and they start questioning, and then the whole veneer of confidence can disappear pretty quickly, as we've seen over the last 12 months or so. This time last year, we'd had 3 months or so, hadn't we, of people thinking, actually, the party might just be over, interest rates are going up, what's happening, where are we going to go?
Yeah.
So I do think it's, and I think slightly over the last 10 years outside logistics, a lot of the returns have been driven by interest rates falling. So we've become particularly sensitive to rising interest rates. And we've also had a period of pretty anemic GDP growth.
Yeah.
So that's the other key driver that will. So if you see the economy starting to tank, then that's a time to worry about real estate, because real estate is a late cycle indicator, and it will respond later to wider economic circumstances.
And then occupier piece?
Yeah, well, again, that's a big GDP thing. That's about growth. If companies are confident they're going to grow, they will commit to space and they will make those investment decisions.
And that's just what being a good asset manager, knowing your tenants, knowing what's going on.
Yeah, I think so. And talking to your agents, I mean, it's about hearing what's happening on the ground.
Yeah.
And we had an annual meeting in January this year, and we were saying, well, you look at the stats for, say, logistics take up in 2022, they were gangbusters. Well, second best year ever, I think, from memory, and right up there. But by even then, you were seeing that in Q4, new requirements had fallen significantly, and there was definitely a slowdown coming, which coincided with a development spike coming through. And it's those sort of things that it doesn't take a genius to know that is going to lead to rental growth slowing significantly, if not falling. And I think we're seeing that in many markets across the logistics piece.
Just having a critical eye, also taking the Amazon piece out of that logistics report, because that made up a bulk of it.
Yes. That has been a factor for many years now. A lot of people said, it can't go on like this, and eventually the music did start with Amazon.
Yeah.
But we sold a logistics portfolio to Blackstone in around about 2018, I think, 2019, and we were worried then about the proportion of take-up that was Amazon.
Interesting.
So it was, it's been a factor for a long time.
But as an industry, and I'm certainly not a fund manager, but I talk to enough people in the space. It seems to be kind of a short-term memory. Is that? Would you say that's the case? People kind of forget, or are quite easy at forgetting, or is that or am I incorrect with that? And actually, the good operators and the good fund managers and the good business owners actually don't forget, and they learn their lessons, and they can kind of see it when the next slowdown comes. Yeah,
what do they say? The most dangerous words in investment are, it's different this time. So I think you're right. I think, yes, it's easy to forget, and it's easy to be caught up in the moment. And I think most of us are in this business because we're optimists, and you always hope things will be different.
Yeah.
But it was Mark Twain said, wasn't it? I think that history doesn't repeat itself, but it does rhyme. Things that there are differences, but overall the cycles be repeated. I mean, we this is unprecedented in many ways, that we've had 15 years without an interest rate rise, and we have effectively zero interest rates for most of that period.
Yeah.
So it is different factors at play, and we've come off the back of a slightly muted boom to a certain extent. Certainly, if you strip out logistics in the UK, because we had Brexit, then we had COVID, then we had Liz Truss, and so there have been a lot of bumps in the road that have meant that not everyone, as I said, if you go outside certain living sectors and logistics, a lot of people will feel this boom has rather passed them by.
Yeah, quite.
But so it is different, but there are a lot of the key fundamentals of supply and demand.
Yeah.
And where that is going over the next few years, both from a capital perspective and a tenant perspective, are the key drivers.
So going back to SG Commercial then, Mountgrade, you were kind of working there.
Yeah.
When did that kind of, it was Hawthorne West.
Hawthorne West.
So Hawthorne West was your asset management business.
Yeah.
Forgive me. So you worked there principally looking after Mountgrade retail fund capital that you did very well, clearly, with selling it in 2006, early 2007. How and where did Clearbell come about, and how did that transition happen?
Yeah. Yes. Well, so we talked again about the boom was clearly coming to an end in 2007, and I'd had a good run with Hawthorne West, and I had a meeting with Martin Myers one morning, and he called me into his office, and I was a bit worried. He looked a bit nervous. I thought, God, that's not good. He's either going to fire me, or he's going to offer me a job. And actually, luckily, it was the latter. So he said, we at Mount Granger are moving from basically a private propco investing our own balance sheet money to becoming a fund management business. And we've got a great track record over the last few years. And on the back of that, we have retained Credit Suisse to do a private equity capital raise. And we need to build a team up to do that, and we need property people. So that's why I came in as someone they'd worked with. We knew each other, I really like working with Martin. And that's how that came about. So I got in at the early stages of that, and I remember doing a video conference call with Credit Suisse around the world from their office in Canary Wharf in 2007, when no one really understood the tech, and it was awful, the lag, you remember, on the latency on those sort of calls and stuff. But it was a really interesting experience. So I was in at the beginning of Mountgrange transitioning from Mountgrange Capital, which was the private property company, to Mountgrange Investment Management Limited, or MIM, and actually became separate businesses. And I was there through the capital raise through 2007, 2008. So that was GFC. It was a challenging environment, but it was a great time to raise some capital. And it was good to be involved in that process to a certain extent as well, because I got brought along to meetings as the sort of market man, and did some travelling, and it was really interesting.
So you went on the road and involved with all the Credit Suisse conversations because you're the market man. How much money did you raise at the time, and what was the strategy, and what was the plan?
Well, especially I wasn't involved in all the meetings,
okay,
but I got wheeled out a fair bit. But it was really Martin Myers and Manish Chandy who did that fundraise. So we raised just under 300 million, and some of which we deployed pre-Lehman's, which was obviously a challenge. In fact, we did one portfolio deal which I was involved with. We bought most of the Prudential Staff Pension Fund, and we literally completed on a deal that was 75% leveraged the week before Lehman's crashed.
Right.
So that timing was awful. Market fell significantly afterwards, and I think by rights we should have been totally wiped out from an equity perspective. But we worked really hard. The portfolio had a lot of asset management to do it. So actually I spent a lot of the period of 2009, 2010 trying to put that deal right. And we worked closely with Tristan Capital was our partner, as AEW became Tristan during the time. And we were quite proud of the fact that we'd never had to put any more equity into the deal, and we ended up showing a 1.2 equity multiple. So not a stellar deal, but in the circumstances, a pretty good result.
How did you avoid being in negative equity or your equity wiped out?
We had some early wins, so we were managed. In fact, the market bounced back quite quickly for prime. There was a bit of a dead cat bounce quite soon after, and we managed, ironically, to sell a couple of the buildings back to the Pru that we'd bought from them. That helped, and then we had a shop in Chichester where the tenant was Woolies, went bust. We let it very quickly to Boots, and we got a good uplift there, and we sold that, which helped stabilise the portfolio too. So we had some good asset management wins, and that really kept the whole thing afloat.
And gave confidence to the lenders,
exactly.
Your partners, that you could actually get through this and drive a bit of a return.
Yes.
And it was a multi-sector.
It was totally multi-sector.
And what would be multi-sector in those times? Is that office, retail and industrial? Because I guess that's still multi-sector now, but you've got all the alternatives that are becoming more and more mainstream. I guess just to really try and drive what was multi-sector, and what were the kind of things that you were looking at, and what was the return profile? Yeah,
you're quite right. It was the three main food groups as they were at the time. So it was mainly offices and retail. There had been some industrial, but it was quite a small part of the portfolio, as it was of most portfolios in those days. We had some retail warehousing, which did better than the high street, but the high street actually, in terms of occupationally, held up better than it was only subsequent that we had the big retail crash in terms of rents and that sort of thing. So we managed to get out of the retail before we got hit by the problems that happened there from a rental perspective. And then there were some offices. We did some office refurbs, some repositionings. But it was soul destroying in many ways at the time, and it did. I think it's fair to say it did suck energy away from the opportunity that presented itself. We were quite focused on patching up the problem assets, not focusing on, and that's a lesson I think that's come out of that downturn for today, is whilst, of course, and we're very focused on looking after the stresses that occur in our portfolio, but we can't make it at the expense of new opportunities which are going to present themselves.
Balancing attack and defence.
Exactly, yeah.
And so was that a kind of 3-5 year business plan, portfolio fund duration? And then, were you involved with kind of raising the next one when you were halfway through kind of the business plan or that period for the next one? We were allowed to fundraise when we were 75% invested. Is that a FCA thing? Or
no, that's typically in the fund documents. So that will be in the limited partnership agreement will say your investors are happy for you to go on the road again once you've got to that level of committed capital.
And that's either going back to the existing investors to ask for more capital or going and raising from
both.
new or fresh?
Both.
Both.
The target, the ideal is to have 100% re-ups from your existing investors,
Yeah.
ideally putting more money in and jobs done in a couple of months and you can all move on.
20% IRR.
Yeah, exactly. Unfortunately,
cash multiples.
Unfortunately, it doesn't often work out like that.
Yeah.
So, but I think one of the legacies of raising capital through the GFC was that we'd had a hell of a lot of meetings, met a lot of people, had a great contact base. And on the back of that, we didn't need to retain a placement agent for our second fundraise.
Someone listening to this who doesn't know what a placement agent is, can you just let them know?
A placement agent is someone who helps you raise the capital. So at the time, Credit Suisse had the market-leading team, and they subsequently broke up and became Hodes Vial and became other entities. Lazard's leading one in the UK probably now. Yeah. So it's effectively an investment banker who has the relationships with the big global investors, the limited partners, LPs as we call them, who they will say that this is a good fund, we've checked it out, these guys are good, you should invest with them. And they manage the process to a certain extent too. Yeah. But they're expensive. So if you can avoid paying placement agent fees, then it's better for the manager.
So you spent a lot of time talking and building your relationships and networks with various LPs. When it came to the second fund, was it a case of utilising a placement agent for some capital raising, but also you had a lot of existing investors to re-up and you could also leverage your own network as well?
Not for the second fund, actually. Second fund, where we did have a break, was getting support from two of the big consultants. So rather than having a placement agent, we had Willis Towers Watson and Townsend, or Aon actually rather, it was the Aon side of the business. Well, they're both pension fund advisory businesses, and insurance as well. So they have a big actuarial side that advises pension funds on strategy. And we got rated by both of those entities, which meant they were comfortable advising their pension fund clients to come into our funds. So we picked up quite a lot of Australian superannuation funds off that, and also some quite big UK pension funds out of that process.
And that was for a commingled fund vehicle?
Yes.
And did you have a preference for type of investors? Because at this stage in your career, you work with high net worth investors, pension fund capital. You said AEW and Tristan were kind of equity on another previous deal. Did you have a preference for the type of capital you wanted in that fund, or was it literally just we need to hit our 300-400 million quid target and we're not overly concerned by the makeup of it?
Yes, to a certain extent. It was more scale. So we wanted institutional investors with who could do 10 to 30 million ideally, or 40, 50 million ticket sizes into the fund. And that's principally what we had. So we've always been predominantly pension fund investors, and equally split between UK and Europe, US and Australia has been typical makeup of our investment base. It's shifted latterly to be more European in our most recent fundraisers. And one of the challenges we've had is with Australian investors who have both changed their template in terms of where they look to invest, because they've become very sensitive to fee loads on their investments. So the private equity model doesn't really fit with a lot of Australian supers at the moment. They've also consolidated, so they've become much bigger entities, and therefore a relatively small country-specific fund is not where they want to be deploying capital, because if you're 100 million check and you're on a £3 million fund, you're a third of the fund, and that is an uncomfortable place to be. So we've had that issue to a certain extent, which is why we're looking to slightly pivot the business at the moment away from that model.
But you're not the only one who's had that issue. A lot of other people have, and that's where there's been a demise of that kind of mid-cap, mid-size investment manager, right? Because as you said, some of these super funds, they want someone to go and deploy 100 million quid ticket sizes regularly, because they've just got so much cash, right? And that's a bit of a challenge. It's
definitely a challenge, and there is also a limit to how big you want to be as a UK only fund. So one is a cap, and the other is one is too much of a floor, and the other is too much of a cap. So the two things don't quite reconcile. So we're looking at changing to raising capital on a more thematic basis now, and a more sector-specific thematic, and a different maybe makeup of capital as well.
So this is under Clearbell, or rather than Mount Grange, right? I don't know.
Yes. So yes.
So just making sure that we've got the distinction of
Yeah.
when Mount Grange pivoted into Clearbell and what that looked like and who was involved as well.
So Martin Myers retired after our first fund. And so when we went to raise our second fund, we changed from being Mount Grange Investment Management to Clearbell.
Got it.
So funds 2, 3 and 4 have all been raised under the Clearbell umbrella.
And the partners at Clearbell, or who are those individuals within the business?
So when we made that change, when Martin retired from the business, Nick Berry, Sandy Dollinden, our finance director, and Rob Mills and myself joined as partners.
Got it.
So it became 5 partners in the business.
Yeah.
And we raised capital on that basis. And we're now, today we're now 4 partners because Nick Berry retired from the partnership last year, although he stayed on as a consultant.
Yeah.
And it's the 4 partners.
And so you touched on kind of raised 4 different vehicles. Have they all been kind of maybe more office, industrial, logistics focused, or have you kind of pivoted the kind of the property type and the mix there? And how do you go about? Because you come onto thematic investing as well, which is kind of what you're kind of looking at now. I'm just keen to see the evolution of how you got to that decision to kind of maybe back certain thematics rather than kind of commingle type funds.
I think for where we sit today, we have a clear advantage in terms of the business we are, because even in the early Mount Grange days, there was quite a big focus on operational real estate. So Manish and Martin set up a business called Trillium in around about 98.
As in Telereal?
As in Telereal, Trillium.
Yeah.
So that was a property outsourcing business, but hugely operational.
Of course, because they had like BT.
They had the BT. Well, it started off with a big government contract.
That's right, and Royal Mail, I think.
Yes, and then picked up BT. Now, actually, Royal Mail, I think, went to Mapley, which was a competitor business.
Yes, you are right. I'm just thinking Duncan Jarvis was obviously. Clearbell. Yes. He was at Mapley.
Duncan was at Mapley. Exactly. So that was an operational business, and again, pre-Clearbell or pre-Managed Investment Management, Manish was on the board of. In fact, I think he was chairman of NCP Car Parks. So again, another real estate operating business bought in by Cinven, who bought that, and Trillium was backed by Goldman Sachs and Manish's Martin's time. So we'd had that operational background, and right from Fund 1, Clearbell, we invested in a hotel business, a budget hotel business, which was called Tune Hotels, which was a very successful investment. We sold that to Wellcome Trust, who just recently exited again, selling it as Point A hotels to Tristan Capital. So it's gone on to be a really strong business. So we've always invested in both beds and operational real estate, and it's side of the business that we're comfortable with and we like, and we've made good money in the past. So I think that sets us up well for what we're trying to do today, and also where the capital is today, what the capital wants to do.
Yeah, I was going to say, people listening to this who haven't heard what operational real estate is, they're probably living under a rock. But for those who are living under a rock and don't know what operational real estate is, because it's a key buzzword, and it has been for a little while, what is operational real estate, and why is that different to traditional real estate investment management?
Well, I just come off a call, actually, with an investor of ours about a platform we're looking to set up in the student housing world called CASA, which is Clearbell Affordable Student Accommodation. Also home in Spanish. So it's a name that we like, and we're marketing it. And one of the key issues we looked at was the operational side of it. So running student housing is a good example. So we charge the students a weekly rent, which they pay on a 41-week or a 51-week term. From that income, we then have to pay a number of costs. So it's the cost of operating. There's an operational cost to produce the real estate income, I think is how I would define it. And it applies to most of the bed sectors, most of the living sectors. It applies to self-storage. It applies to other spaces that are growing fast. And it's at one point we called it customer-focused real estate, or real estate as a service. So it is about delivering the property assets in a way that the customers really want it to be delivered. And that is one price for the whole thing. And how it's run, how it's operated, that's someone else's problem. That's the landlord's problem. That's not their problem.
But typically, real estate investors would buy the real estate and then an operator would operate it. But
they would have a lease on an FRI terms, which would mean all they got was 4 rent checks a year, and someone else can deal with all with all the hassle.
But now, increasingly so, traditional real estate investors are looking to own operating businesses as well and capture what capital and income and the upside from both sides, right?
Yes.
But it's a slightly different mindset. There's a risk element to owning, operating businesses. So I guess you have to, how do you get your head around that, and how do you set that up properly?
Well, it's a good question. It's about the people, really. I think that's the key, is do you have the right people running it who you trust? And it's about creating the right alignment of interest. So those people have to have skin in the game. If they are going to be responsible for running something prudently and not letting costs get out of control and maximising the NOI, and that's the key word, it's what is your net operating income out of your operational real estate, then you have to clearly have the right people operating it. And I think that's what we've been good at over the years, is identifying the right teams and the right people to produce the right net returns. And that Point A Hotels is a good example. As I said, that's gone on to do really well for subsequent owners. And it's always good to see deals perform strongly for people you sell them to.
So Manish obviously has got quite a lot, or had a lot of experience in terms of the operational real estate piece, and you've obviously done that as well. Moving on to the other themes, and you've obviously identified student accommodation with CASA as a clear interest now. What are the other areas that you're seeing are interesting in the market?
A couple of things before I answer that question. One is, it's fair to say that Rob Mills is my partner, who really focuses on running the operational businesses. So day-to-day manages more of a chairman role.
Okay,
and Millsy is the guy who's embedded with the operating businesses. And really is the expert. He comes from an accounting background, as well as private equity. So that plays to his skill set.
Got it.
Before I move on to look at other themes, I just want to have a little bit of a promotion on our student housing problem, because we're really excited about the opportunity. I mean, a lot of people are looking at student, and student has great sort of features in a way, in that it's two very important things for the moment, is that it does not depend on GDP growth to perform. In fact, there's almost a reverse correlation in some cases in terms of student numbers. And it also offers inflation protection, because you put your rents up every year, and the customers are comfortable as they can be with those costs going up. But so that's the sort of the macro, but our real focus is on providing what we call affordable student accommodation. And we think that this is a really interesting space, because we're able to buy at about 35% of replacement cost. So it's very difficult to increase the supply of that sort of space. And at that level, we can afford to give it a decent refurb, to bring it up to standard from an ESG perspective, from an EPC perspective, but also still let those rooms out at the bottom quartile rent in any given market. And that's where we see the strongest growth in demand coming from, is students focused on affordability. Obviously, there's a cost of living crisis, and everyone is looking at affordability to a certain extent. But we are also seeing increasing pushes from universities for widening participation. So more students coming from low-income households. And we're seeing a shift in our overseas student population away from relatively prosperous EU students and Chinese students to much more budget-sensitive Indian students and Nigerian students and South African students and what have you. So we see both restricted supply, because you just can't build any more space at that price point, and growing demand in this affordable space. And we also see there's an ESG benefit to providing affordable accommodation. There's a social plus to what we're doing, which we think is appealing both to us and also to investors.
So a student accommodation investment agent listening to this, what's the kind of criteria? What kind of things are you looking at? Are you buying kind of old blocks that you can kind of refurb, bring up to speed, but save, kind of knocking it down completely and saving quite a lot of carbon? Like what kind of size and where?
Exactly. So we're looking for well-located, first, second generation student accommodation that needs CapEx.
Got it.
So that's typically why someone will sell at those sort of price points, because they don't have the free capital themselves to invest in it, and everything needs investment. And EPC is a big driver to that. We are not 100% focused on Russell Group University towns as well. We like the former polytechnics, the more vocational universities, because we think that's where student demand is growing, because people are more likely to get a job after it than doing an arts degree, for instance. So locationally agnostic, but clearly there's got to be a good story in terms of the local supply-demand dynamic and the viability of those individual universities as well, because some are not as strong as others. So it has to have a viable university, the right price point for us to come in and let out at the right level to an area where there's demand.
How does it work in terms of setting and picking these themes and strategies? How do the partners and investment, or the whole team sit together and go, this is an idea, or this is what we're reading, or this is what we're seeing, or where do you get these bits of inspiration from, and how does it evolve from some ideas to an actual strategy that you go and talk to investors to go and raise capital against?
That's a good question. I think clearly we all have a view. We're very keen to hear from the younger people in the office, because I'm 50 something now, and my other partners are 40 and 60.
Yeah.
So we're not the ones that are determining what is going to grow in the future. So it's about hearing what people in the office are experiencing. Also, my kids are all been through universities and are now trying to find flats in London, and that's another area, where we could talk about the growth in rents. So it's about being aware of the macro, the key secular drivers, the shifts in behaviour. But then it's also about combining that with finding the right people. So we've sometimes gone out, and if you can find the right team then to deliver that, or we see a lot of teams and we say no to 10, and then the 11th will say, actually, that is in a sector that we're interested in. And that's happened with student housing. That's also happened with another one that we're working on at the moment, which is a business called Trade Stars, which has come out, which provides micro-fulfillment in Zone 2 London. So it's micro-fulfillment and studio space, principally targeted at internet retailers. But actually, these units also appeal to others, as we're discovering, as we're launching our first site in Hackney at the moment. And that was partly led by the team who came to us. They'd had a very strong track record in dark kitchens. They built up a good business. They'd exited that. And they said, this is the next idea we'd like. And we'd been trying to get into self-storage for a long time.
Which is huge, right?
Huge, right. And we'd identified that as a real area. And we'd been through 3 different potential partners to try to get the right, to try to find the right thing, the right structure, the right way of accessing the market, and we'd failed. And this came along, and this wasn't quite self-storage, but it had links. It was a sort of, if Big Yellow offered a WeWork wrapper, it's what you would end up with. So not that WeWork necessarily is something you want to be advertising right at the moment, but it's that idea. But it's that sort of slightly sort of genre-defining, sector-defining, niche-defying rather than defining, and to create an area which is a little bit of storage, because we offer goods in, goods out, so you don't have to be there when you have deliveries, and you can see things going out. But we also have podcasting rooms provided, so people have photographic space, so they can take pictures of what they're selling, and provide, when it gets too much for the spare room and you want to move out, then that's what we're offering.
It makes complete sense, because I sat down actually last week with a fund manager who's doing this self-storage, and we were just talking about the broader economy as well, and he said self-storage has typically been a defensive asset class, death, displacement, divorce, people kind of need storage. But he said via Instagram and TikTok, these influencers selling perfume, and making millions of pounds a year, they are the kind of people who need the space that you've just spoken about. They get their shipment in of product in their parents' house or their own flat, and it gets too much, and actually they need somewhere where they can serve a day or a week's notice. Or take up space very quickly and very flexibly, and that completely makes sense.
That's exactly what we're offering. But also, and I don't want to sound too WeWorky about this, but there's also a community aspect. So there is a benefit from not only providing the right sort of space, but also being located next to other people and having a coffee space and a breakout space with other people running similar businesses, where you can interact and you can talk and share lessons and advice.
Manufacturers and ecosystem and all of that. So it's fascinating. Because it's like that merge of like the office, industrial, internet, piece all kind of converging in one. Right? Yeah. So it's very interesting. We've committed some amount of capital from our 4th fund into the venture. We are talking in advance to 2 other investors coming alongside the fund capital to allow us to grow it. But there is I think a lot of investors, as you know, are risk off at the moment. So a lot of people are saying, well, come back to us in a year's time when you've proved the concept, or 2 years' time when you've proved the concept. So we think we can get great returns now at the higher risk stage, but we will look to recapitalise that as we've proved the concept
and bring in a lower cost of capital in due course, and look to grow that as another platform going forward.
And are there any other kind of themes that you've identified without giving away everything?
One we're working on, and I know it's a space that you've been looking at a lot, is single family housing.
Yeah.
We've, I suppose, struggled in the PBSA space, in the BTR space.
Yeah.
We were probably too cautious in terms of the returns we underwrote, and said, for development risk, that's just not enough.
Yeah.
I think that those returns have come through because we've seen quite a marked yield compression over the period of years. So we feel we slightly missed out on the rental space, but we think single family housing is an interesting one to look at because it's probably the next area, less institutional, and that therefore gives us an opportunity to get in a bit earlier. We own a business called Spring Move, which is in the quick sale residential business. This is owned by our third fund. So it's a bit like WeBuyAnyCar.com for houses, which makes it sound a little bit flippant, but what the service it provides is typically for people moving into retirement accommodation. They will go to their retirement developer, and the retirement developer will offer them a part exchange deal on their family house in exchange for a new apartment. And we will fulfill the part exchange part of that process. So we will buy it at a discount to market, often topped up by the retirement developer. So we have this business, and it's growing. Although it's been a challenging market for it, it's well positioned, we think, going forward. But more importantly, we have a platform that has residential coverage around the whole country. So we think that might be a channel for us to get into single family housing. And that's one thing we're exploring, and other ways as well at the moment. And the timing, I think, is interesting because more house builders are feeling the pinch.
Yeah.
Clearly. I wouldn't say it's distress, but there's definitely stress around.
Yeah.
And I think that's something we can take advantage of, and why it might be an interesting time to get into that market.
The We Buy Any Cars model is interesting though, and I get it completely, but you're not going to be buying, £5 million house and then a 200k house. There must be a strategy there in terms of the types of houses and using, curating a portfolio of things, because I guess the exit for you is amalgamating it all and then at a premium selling it on to someone else, right? Where is that located and how do you manage that?
So I think it's important to separate the strategy that Spring Move has at the moment, which is within that quick sale residential market.
Fine.
And how we might use that platform going forward. And I think the focus on single family is much more on new build.
Got it.
And acquiring new build at a discount because the developer needs liquidity.
Fine.
And building up a portfolio
that way.
But it means we have the feet on the ground, and we have the pricing expertise, and we have the management capability in a platform which we already control.
How does one become so flexible? Building, years ago, instead set up the business, it was kind of office, industrial, retail, and now we're talking, as you said, kind of thematic operational real estate in kind of sectors that you probably wouldn't even touch years ago. Although you had an understanding, I guess the business plans evolved. How have you been able to kind of pivot and bring investors on the journey and bring the team on the journey and bring in new skills to kind of enable you to constantly evolve and be front of mind and best in class?
Well, I think that there are sort of two parts to that, because we haven't completely moved away from the traditional food groups.
Yeah, fine.
So we in our third fund, which is the last one that's fully deployed and is now exiting, we're 50% logistics in that fund. So it's always been around about a third of each fund has been on the operational side of things. So it's about expanding that for the current circumstances. But the team are fully engaged. So our head of asset management, Alice Murray, for instance, sits in on the asset management and the board meetings for the micro fulfillment business.
Yeah.
Because it's useful to have someone with a property background when you're buying we bought a long lease off from City Corporation in Islington, to have someone who understands the real estate, because that's what our partners don't really have. They know how to run the operational side of things, but they don't have the real estate background. So we've engaged the asset management department on that sort of, and from that sort of perspective. And our analysts, which is a big part of our business, are totally flexible. They just want to be involved in deals.
Yeah.
And actually the complexity and the challenges that come through from operational side are very interesting from their perspective. But we're still doing, we bought a logistics portfolio recently.
Yeah.
So we're still focused on that side of things. and we're still looking at an opportunity to come back into London offices at the right time. So we're not completely walking away from that, no, but it's just at the moment, the capital and we think the best occupational prospects are within this space, because we're in a really challenging environment. I think, you go back to talk about what we learned from experience, but what we've never experienced before, certainly that I can remember, is a period where we've had such flat GDP growth for so long, and the prospects, as far as most commentators can see going forwards, look pretty grim too. And without GDP growth, and on top of all the structural issues that are going on, for instance, in the office world, it's quite difficult to see how you can really get performance. But then, conversely, if everyone's saying it's never going to perform again, then something like London offices could become an interesting cross-cyclical play, particularly when we're seeing some stress coming through from the banking sector and refinances and a lack of capital coming in. So that's, I don't think we'd want to totally write everything off, because I think that's when you should be buying, is when you think everything's written off. So you can't all be pro-cyclical. I think you've also got to have an eye on the counter-cyclical opportunities that might present themselves.
What are some of your learnings of building high-performing teams, hiring top performers, just in terms of insights, in terms of what do you kind of look for, and what distinguishes maybe someone who is a high performer from someone who isn't?
It's difficult. I'm not. I defer to you completely on this one. But I'm not a very good interviewer, so you obviously look at CVs, and I think you have a clear idea of what you're looking for. I think is obviously a good starting point. And I tend to decide within about 5 minutes of meeting someone whether they're right or not. And you talked about Duncan Jarvis earlier. I mean, I knew instantly that he was just the person we needed within 2 minutes.
How? What separated him from the four that came through the door before him?
He was punchy. He was hungry, and it just came across so quickly. And we needed someone in that team who would bring that energy and that hunger. And I think, particularly on the asset management side, but I think on all sides of the business, I think one thing you can't teach people is that hunger. I mean, you can teach people a lot of things, but people who get out of bed in the mornings because they want to do a deal, that someone comes from an agency background, that is something that you either have or you don't have.
So it's the behaviours.
And it's that sort of, and a lot of times when I talk to, interview people for asset management jobs or analyst jobs, particularly asset managers really, I want to know about the deals they've done, and where we've have crossover, where we've, common ground. And that's obviously a key part, is finding common ground when you're trying to connect with someone. But I want to hear how they talk about deals and things like that.
Check their eyes, see if they light up, and like the impact and everything that they did. Interesting. So what are you most excited about at the moment? We sit here kind of towards the end of August 2023, kind of looking ahead. I know we touched on some of these themes and strategies you're kind of keeping an eye on. What are you most excited about from a kind of a real estate investment management perspective right now?
Well, I'm very excited, and I've probably talked about this too much already, but our student housing, I think that is where we, between now and Christmas, where we expect to hopefully to close in on an investment partner, capital partner, ideally close a capital partner. And we've got some quite advanced discussions, whether we go down the single investor route or a club deal. I think that's much more likely than going down the fund route at the moment, because I think it would just take too long to pull a fund together.
And a fund would be a commingled fund, dedicated at it with the closed end to do it. And a club deal is 3 or 4 investors all aligned, similar lot size, similar check sizes they would put in.
I think probably in an ideal world they would be balanced. But the key difference as well is that the club deal would not give us complete discretion as an investment manager. So the commingled fund has the benefit of us being in complete control.
Got it.
Whereas we'd be working in partnership much more
with the investors.
But I think that's just where the market is today.
Where does it come to when you've got a single investor, in terms of calling those shots?
Well, I think then you're working for them rather more. Clearly. So I think that becomes a more dominant position. But that might be a trade-off we accept in order to raise the capital very quickly and be able to deploy it quickly.
Got it.
And then be able to move on to the next phase of that deal and move on to other deals. So it's a trade-off which we'll have to consider carefully over the course of the next couple of months. But I think that's a big focus for us. The other area where I am excited is in small logistics deals. So we bought a portfolio from Palace Capital, the REIT, which is
Neil Sinclair's, I'm sure.
Was Neil Sinclair's.
Yeah, it was. Yeah, it was.
I mean, they are selling quite a lot at the moment. It's in the public domain.
Yeah.
And we managed to buy all their industrials in a sort of off-market transaction. I say a sort of, because a couple of buildings had been marketed, but we managed to do a deal on the whole lot.
Yeah.
So it's about 34 million. So not a huge deal, but it gives us a great platform now to add to it. So we've got debt in place from Aberdeen on pretty competitive terms. It's an accordion facility, so we can expand it as we find more deals. So we're keen to find an equity partner to come in alongside us and to grow the portfolio. Because to answer your question about what I think is exciting in the next 3 months, we're seeing quite a lot of smaller industrial deals. So in the 5 to 10 million pound bracket that just are not finding buyers at the moment. We've seen pricing move out, and we're seeing yields get to a level that we haven't seen for some time. So, I mean, we've already obviously seen a 25% correction in the last 15 months in the space. But I think we're now able to pick off individually. Now we've got the seed portfolio, we can bolt on some really quite interesting deals.
Because that's typically more operationally intensive, right? Those smaller deals, which typically institutional investors wouldn't touch because it's too granular. Yeah. Is it getting a little bit too toppy for high net worths or small propcos that would ordinarily buy those kind of deals? Or they just don't want to go near it just because of the operational challenges?
I think high net worths are having problems with, everyone is worried about I think it's easier to not buy anything than to buy something at the moment.
Yeah.
I think debt is challenging on the smaller deals. And I think the smaller institutions that would be in that space typically as well are out of that space. Yeah. So that there's a distinct lack of buyers. And it's something we've done a number of times now, which is build up portfolios on a granular basis. And we've exited 3 historically to Blackstone, Logicor and Mileway. We've exited 1 to Threadneedle. So it's a strategy that's worked for us well in the past, and we think we can get up the scale. And we're confident long term in the dynamics in that market. We're buying below replacement cost, so supply is not going to really run away with itself of that particular price point. And we think it's attractive. There's still some good reversions to go for. So that is, and I've left the team fine-tuning a joint venture paper at the moment, which we're preparing to work on finding the right capital partner.
Very interesting. So look, as we draw to a close, I'm mindful of time. A question that I ask everyone on the podcast is, and I know this is going to catch you off guard, is if I was to give you £500 million of equity, who are the people, what property, and which place would you look to deploy that?
Good question. Well, and I know you gave me time, and I did think, well, it's obvious. We'll put money in our CASA, student housing. We'll put money in logistics. Yeah. I do think that London offices is a contractual play. Yeah. Again, is an interesting
super prime.
Super prime, fun enough, has held up better than we anticipated. We have invested in a couple of our funds a French family office, very established, traditional owner of lots of super prime offices in Paris, want to buy the same in London. And we've looked at a couple, but they just haven't softened that much. So there's a building in St James's Street, 55, going through at a yield of around about 3.5%, which, okay, is off a bit, but it's still quite a strong price. And so I think just off super prime. And I think where you have more transitional, where you have tenants coming out or tenants not renewing, debt coming up, then I think we'll see some quite big discounts. So I think I would go a little bit further up risk curve, but I think more core plus than value add. Yeah. So in terms of the place, the final place, and I know this is a bit left field because I have absolutely no experience there at all, but I think somewhere like Poland, because I mentioned earlier, I'm concerned about the low growth prospects for the UK generally. And I think over the last 10 years, the UK has grown at 0.5% per annum GDP and Poland's grown at 3.5% per annum. So there'll soon be English builders going out and working in Warsaw.
Yeah.
And I think that Poland, I think there are real problems, and we take liquidity or relative liquidity in real estate a bit for granted in this country. And I know that if you go to a lot of other countries, it's much harder to sell, it takes much longer. And I think if you can get comfortable with liquidity, I think just to invest in somewhere where you see growth. And I think we've long debated whether we should be more active, whether we should look to do something in Europe.
I was going to say that because you're UK, aren't you?
We're totally UK.
And that's the question I was going to ask you in terms of, was that a conscious decision rather than expanding into Europe?
It has been a conscious decision, but we talked earlier about how the model is changing, or rather our old model is no longer in demand to the extent it was previously. And part of that is, and we've talked to various people over the years about potentially joint venturing or them investing in us to invest in Europe or partnering with someone who already exists. So it's definitely something that is there under consideration. It's not something we're actively pursuing, but we have a couple of irons in the fire.
It would be remiss of a property entrepreneur like yourself and the wider team not to look at your options, not to consider it, and not to look at where returns and potential growth could come as well.
But I quite fancy, and I've always quite fancied Eastern Europe or Central Europe, because I don't think Germany's got any greater growth potential than we have.
Even given Ukraine and Russia's situation?
Yes, and I did think about that. I think even given Ukraine, maybe that's the time an interesting entry point. I certainly wouldn't invest in Ukraine itself,
right?
And I wouldn't invest in Belarus. But I do think, as I said, I think Poland is quite an interesting place that it's growing fast. Yeah, is I think relatively strong regulatory on a relative basis. I think the regulatory framework is better there than some other countries in Eastern Europe, and I think that might be an interesting space. I think going any further afield than that would be a challenge.
And how about the people part? And of course, you can have your amazing team of 30 odd at Clearbell. You're clearly very well networked and very well known, and you've got a lot of peers who've kind of gone through the ranks with you who are doing amazing things across the industry. Yeah. Would you grab any of those on the journey to help you kind of build or deploy this capital into those various different kind of places and projects?
I'd take all of them. And I'm joking apart. We've talked about this recently. We've had a few changes in lineup. Personnel, and sadly our fourth fundraise wasn't as successful as we hoped to, and we had to make a couple of redundancies, which is obviously very sad because we worked with people for a long time, but it does mean that we have a very lean, focused, capable team, and we're very comfortable with where they sit at the moment and the prospects within that. I think the other thing that we are open to is we've got a big platform. We've got the capability to take on more entrepreneurs. So we've had a couple of conversations with people to come in and to scale, to use what we have, to come in with a great idea, with a great fund management idea, with great capital, but need the platform around them. And that's something. So those are the people that I'm most interested really in bolting on at the moment. And it might be in one of the places that I've already talked about in terms of deploying, but it might be something totally different. So I think that is something that, in fact, I think one of my projects between now and the end of the year is to work a little bit harder on that, is to who are the next generation of entrepreneurs that we can team up with
and tap
into, and we can offer a lot in terms of experience and support. What can they offer in terms of energy and ideas?
Well, yeah, I'm doing a search at the moment for a similar business that's been more office focused, that's got a lot of capital behind them, and actually we're retained on a search to find them someone to come and head up their living platform. So that's obviously kind of clearly defined, but I guess for you, you're a little bit more open to ideas in terms of what that might kind of look like in terms of kind of area or niche or something to go and get, and they can get the backing and the benefit and the resources that you and the team have in place to go and deploy and build a business within a business, as it were.
Yeah, maybe that's something that you can help us with.
We'll see. Well, look, Rob, thank you so much for coming on the People Property Place podcast. I think, a key thing that I've certainly taken away from here is just like the value of relationships, long-term thinking, being able to kind of reinvent and pivot and learn from certain situations and, constantly looking to kind of improve and capitalize on the opportunities ahead of you. So thank you so much for joining me. I'm sure that everyone listening has learned an awful lot as well. I certainly have, and looking forward to seeing what you and the team go on to do.
Well, Matt, thank you very much for having me.
Not at all. Cheers, thanks. Thanks for listening to this episode of the People Property Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests we should get on the podcast or areas of the market we should explore further. So do drop me a message. The People Property Place podcast is powered by Rockborn. The team recruit experienced talent for investors, owners, developers, and operators. So if you're considering your career options at the moment or looking to attract top talent to work for you, head over to the website www.rockborn.com, where you can find a wealth of research to aid your search. Have a great day wherever you are, and I look forward to catching you next time.